Well, let me run quickly through some of the key amendments that have been passed today. These are, of course, amendments that have happened, and I'll also talk about what hasn't changed because it's important from a market standpoint. First, the big one, the change in the taxation regime for debt mutual funds. Actually, it's not just debt funds. Even gold funds get impacted, and even fund of funds get impacted. Why? Because now any mutual fund which has less than 35% of its assets invested in domestic Indian equities will no longer enjoy the indexation benefit. The taxation is going to be on a short-term basis, which basically means you get taxed at your slab rate. And that would be a big blow for the debt fund industry. That's the big one, the big headline. The second point is actually good news coming in for the offshore banking units at IFSC or GIFT City. There is an enhanced tax benefit that's come in because up until now, a new entity that was setting up shop in GIFT City, a new offshore banking unit, would get a complete tax exemption on income for the first 5 years and then a 50% exemption on the income for the next 5 years. Now this has been enhanced all the way up to 10 years, so 100% deduction on income for 10 years from the time of setting up at GIFT. Let's move to the third one, and this is quite important, specifically when it comes to royalty that Indian companies are paying to overseas entities, non-resident entities or foreign companies. The rate of tax on this royalty has been doubled from 10% to 20%. And why is this important? Because the foreign companies that currently do not enjoy any treaty benefits, the double taxation avoidance treaties, for them the tax incidence will go up. And even the ones who want to take the treaty benefits will have to ensure that they meet all the filing requirements, they file their income tax returns to be eligible for the lower rate of tax as prescribed in that treaty. So we need to watch for a lot of the royalty payouts that go to foreign companies. Then what has not moved, and this is also important from a market standpoint, just to recap, absolutely no change on insurance. So for non-par policies, the cap stands at 5 lakhs for a year. It has not been increased to 6 or 7 lakhs as the industry was hoping for. Also, there is no change in taxation with respect to REITs or InvITs. What the budget had done on the 1st of February is that repayment of loans was a manner in which REITs were distributing the interest income to the end investors. This was more tax efficient, and this has been plugged, and no changes in the final amendments that have been moved today. So basically, this will be taxed as income under other sources and not as capital gains. There was a lot of representation that changed it to capital gains that would have been more tax efficient, but the Finance Ministry has not obliged. Last but not the least, also no change with respect to the reinvestment of capital gains in residential property. Remember, the budget had introduced a cap of 10 crore rupees. You cannot reinvest in residential houses above 10 crores if you want to get the reinvestment of capital gains benefit, and that cap remains on some of these high-value residential properties. So those are some of the key amendments, what has changed, and some of the changes that have not been made, which will apply from the 1st of April.